In today's rapidly evolving financial landscape, algorithmic trading has become essential for staying competitive. It offers speed and efficiency that manual trading simply can't match. This presentation explores Binance's algorithmic trading tools, focusing on time-weighted average price, TWAP, and percentage of volume, POV. These strategies are designed to minimize market impact and optimize trade execution. Through real-world case studies from the Binance platform, we'll demonstrate how these tools enhance trading performance. Building upon the importance of algorithmic trading, let's examine how it works on Binance. Algorithmic trading utilizes computer programs to automate trades based on predefined rules. Binance provides two primary methods, TWAP and POV. TWAP distributes trades evenly over a set time, reducing market impact by breaking large orders into smaller chunks. POV, conversely, executes trades as a percentage of total market volume, dynamically adjusting to market activity. This also helps to minimize market impact. While these tools are valuable for mitigating slippage and minimizing market impact, especially with large trades and illiquid assets, smaller trades with highly liquid assets might benefit more from traditional market orders. Optimal use depends on factors like trade size, asset liquidity, and the specific algorithm settings. To further clarify, let's define TWAP and POV. TWAP, or time-weighted average price, divides a large order into smaller orders executed evenly over a specified time. For instance, a 1-hour TWAP divides and executes the total trade volume equally over that hour. This strategy helps minimize market impact by preventing sudden price fluctuations. POV, or percentage of volume, executes trades based on a chosen percentage of the total market volume. If a trader sets a POV algorithm for 10% of the market volume within a given time frame, the platform will execute trades accordingly. This approach ensures trades are executed dynamically, aligning with the overall market activity. Did you know that even small discrepancies in trade execution prices can significantly impact overall returns? This presentation explores how algorithmic orders can help manage these price variations known as slippage. We'll analyze 25 real trade data points from Binance, comparing algorithmic orders with traditional market orders to highlight their potential advantages. We define edge as the performance difference between an algorithmic order and a traditional market order. A positive edge suggests the algorithm outperformed the traditional order, while a negative edge indicates underperformance. Importantly, the data presented reflects past performance and should not be taken as a predictor of future results. Building on the concept of algorithmic order performance, let's delve into two specific strategies: time-weighted average price, TWAP, and percentage of volume, POV. Analyzing their performance across various factors like trade value and asset type reveals intriguing insights. For instance, across all metrics, TWAP showed a negligible difference in slippage compared to traditional orders. However, POV demonstrated a substantial positive edge, outperforming traditional orders by a significant margin, especially when managing slippage for less frequently traded assets. This difference highlights how the choice of algorithmic strategy can drastically affect trade outcomes. Let's now consider how trade size influences the efficacy of algorithmic orders. As trade sizes grow, slippage tends to increase, making order execution strategy more critical. Our analysis shows that for large trades, particularly those involving illiquid assets, algorithmic orders provided considerable advantages, minimizing slippage by around 13%. However, this benefit diminishes with smaller trades of liquid assets. This is because liquid assets often have sufficient existing liquidity, reducing the need for complex algorithmic execution strategies for smaller transactions. Did you know that algorithms can significantly impact your trading outcomes? This slide delves into a comparison between two common algorithms: time-weighted average price, TWAP, and percentage of volume, POV, focusing on trade size and duration. For large trades, POV often surpasses TWAP in performance, particularly with larger quantities. This stems from POV's execution rate, which increases in line with market volume, allowing it to move with the market and minimize slippage. The chart on the left visually demonstrates POV's growing advantage as trade size increases. However, while POV may offer a performance edge, its execution time can vary greatly. Sometimes POV trades might require over 8 hours to complete, whereas TWAP consistently executes within a shorter time frame, as shown in the second graph. This trade-off between speed and potential profit underscores the need to select the algorithm that aligns with your trading objectives and risk tolerance. As a reminder, these graphs represent the edge, calculated as the percentage difference between the executed price of the algorithm and a benchmark. A positive edge signifies outperformance, while a negative edge indicates underperformance compared to the benchmark. Building upon the comparison of TWAP and POV, let's analyze specific settings within each algorithm. This case study, Case 4, focuses on the impact of Algo configurations. First, we'll examine TWAP duration. The chart reveals that extending TWAP duration beyond 1 hour for liquid assets results in negative edges. This suggests that liquid assets, due to their inherent trading activity, execute rapidly, making longer TWAP durations inefficient. Shorter durations generally yield better returns. Next, let's explore the influence of limit price. The simple act of adding a limit price for both TWAP and POV can drastically improve the median edge, as demonstrated by the substantial gain shown in the graph. This risk management technique safeguards against sudden price swings by preventing execution at unfavorable levels. Let's recap the key findings regarding TWAP and POV algorithmic trading on Binance. Firstly, slippage tends to rise with lower liquidity and larger trade sizes. Employing algorithmic orders, whether TWAP or POV, offers tangible advantages by reducing slippage, especially in these scenarios. While both are effective for large illiquid trades, TWAP might necessitate more careful configuration, such as setting an appropriate order duration. As a general guideline, using a limit price is advisable to protect against short-term price volatility and minimize slippage. For users trading smaller volumes of liquid assets, direct market orders often suffice due to ample liquidity, and the potential downsides of incorrect algorithm configuration could outweigh the advantages. Finally, these algorithmic orders can help mask the size of large trades by dividing them into smaller portions, lessening market impact and facilitating smoother trade execution. Sophisticated algorithmic order types, such as time-weighted average price, TWAP, and percentage of volume, POV, offer traders powerful tools for executing large orders and navigating illiquid markets on platforms like Binance. These algorithms aim to minimize slippage and reduce market impact, crucial considerations for large volume trades. However, simply selecting TWAP or POV isn't enough. The true effectiveness of these tools lies in meticulous configuration. Factors such as trade size, asset liquidity, and prevailing market conditions must be carefully considered and integrated into the algorithm's parameters for each trade. By tailoring these settings, traders can optimize algorithm performance and significantly enhance trading outcomes. To further enhance your understanding of algorithmic trading, consider these resources. What is algo trading and how does it work? Provides a comprehensive introduction to this specialized trading approach. Your guide to Binance trading bots offers practical advice on leveraging automated trading tools within the Binance ecosystem. Lastly, what are crypto trading bots and how do they work? Explores the broader world of automated cryptocurrency trading, covering various platforms and strategies. Thank you for your engagement.